Hi, I'm Roger Montgomery from Montgomery Investment Management, and welcome to this week's Video Insight. Well, we certainly live in interesting times. $17 trillion worth of sovereign bonds from the likes of Germany, Japan and Switzerland are trading at negative yields. That's equivalent to about 20% of global GDP. And the Bank of International Settlements, which is the central banker's bank, described it as vaguely troubling. In fact, they were saying that when the unusual becomes routine, we should be concerned, and I agree with that. What's more concerning, perhaps, is not so much sovereign bonds and the quantum of sovereign bonds being at negative yields, but the fact that we now have junk bonds or CCC rated corporate debt also trading at negative yields. So let's take a step back for a moment and just think about what that means. If you buy a bond at face value, then you expect to get face value back at maturity of the bond, as well as the coupons or the interest. You might pay a premium over that face value, which means that you're going to receive a lower yield than the person who bought those bonds at face value. If, however, the premium you pay above face value is greater than the remaining interest payments on that bond, then you're going to lose money if you hold the bond to maturity. That's the case with junk bonds trading at a negative yield. The premium is so high and the interest payments don't make up that premium, so holding them to maturity results in a loss. There's also the possibility of loss because these are, remember, CCC rated junk bonds or high yield bonds. They're issued by companies most likely, or least likely rather, to pay back the face value at maturity. So if the company defaults, you lose money. If the company doesn't default, you lose money. So what gives? How are investors, or why are investors buying these bonds? It's pure speculation. The hope is that someone will pay an even higher premium and accept an even worse negative yield, and that the investor will be able to trade out of these bonds at a profit. So if you think things are a little insane, you're probably right. I don't know how this will play out or whether it might work out. We could just plod along here for a very long time. But what I do know is that when people are buying, or institutions are buying securities simply on the hope that others will pay more, then that's what John Kenneth Galbraith explained is a bubble, by definition. How it ends is anyone's guess. I look forward to talking to you again soon. In the meantime, please follow us on Facebook and Twitter.